Greetings and salutations, everyone. Welcome to Liberty Call for Tuesday, June 14th, 2022. I hope everybody's having a great day. It is much nicer here today in Colorado. The 90-degree temperatures finally broke. We got a little bit of a cool front. It is, 79 degrees outside, and it's only 75 degrees in the house upstairs. So much nicer. I think it took until probably midnight before the temperature on the main level and then the master bedroom got down below 80, and it was a little toasty. So, good thing we had to run into town yesterday evening. I had to drop my truck off for some service. So we did get to enjoy some air conditioning in a restaurant while we had dinner. Anyways, like I said, hope everybody's having a great day out there. Another ugly day in the markets. I mean, the redheaded stepchildren are out in force and they're just beating them up. So anyways, I realized I'm a little early today. I'm about 6 minutes before I normally start, but I've been having meetings and I might have one at 3. I don't know. That person hasn't confirmed. I'm not going to call you out on national television or, well, the dozen or so people who actually open this occasionally. So, all righty. Well, let's go ahead and, let me start. If it's your first time watching, give me a big old thumbs up. There it is. There's my thumb. Like, share, subscribe, all that good stuff. Please share it with friends and family. I've had a number of folks recently who've been like, hey, I'd like you to talk to X. They're worried about what's going on. They need to get their crap together. Please send them my way or, shoot my contact information. Shoot this video to them. Hey, I'm pretty entertaining, I think. I don't know. All right. Well, let's go ahead and look at the markets and see how they did today. Definitely not as bad as yesterday. So that is, the good news there. The Dow Jones is down 0.5%, closed at 3364. The S&P 500 was only down 0.35, closed at 3736. NASDAQ slightly up 0.18%. Closed at 10,828. Small caps were down about 1/3%. The VIX did recede today, 3.91%. It's still sitting over 30 at 3269. Moving on to the other exchanges here in the Americas, Canada down just under 1% at 0.98. Brazil down 0.67. Mexico down 0.63. Moving on over to Europe, Germany was down 0.91. UK down 0.25%. France down 1.2. Euro Stoxx was down 0.78. Netherlands was down 1.31. Spain down 1.43. Italy down 0.32, Switzerland down 1.81, Portugal down 0.48, Belgium down 0.95. And let's go ahead and move down a little further, leave out some of these small ones. Both Russian exchanges were up. The MOEX was up 0.19. The RTSI was up 0.33. Let's move on down move over to Asia and see how they did overnight. Japan was down 1.32%. Australia down 3.55, New Zealand down 2.52. Looks like most of the Chinese markets were in the positive. The Shanghai was up 1.02, the SESE component up 0.2, China A50 up 1.07, and the DJ Shanghai was up 0.91. The Hang Seng looks like it was either closed or is flat. So shows it was up 0.41 points. So I guess it was just flat for the day. And the Taiwan weighted came in down 0.15%. So all in all, a much better day than yesterday. Yesterday's market was ugly. And actually, let me jump back over here. Let's take a look and see commodities because everyone's worried about fuel prices. WTI was down 2.21% today. Brent down 1.44. They're both still hovering around that $120 a barrel. So gold has continued to pull back. Little surprising, the dollar's been rising. For a few days there late last week, the dollar was rising and gold was going up. And that's usually, they usually work inversely. So I was a little surprised. So maybe what's going on with gold, yesterday, today is just playing some catch up. But I think it'll be an important asset to have having those metals in your portfolios long term because when things get ugly, people return to safety. And, that's, what a lot of people consider safe. All right, well, let's go ahead and jump into today's market recap. S&P 500 stutters as surging Treasury yields point to hawkish Fed. The S&P 500 weaved between gains and losses Tuesday as worries that the Federal Reserve could deliver a larger than expected rate hike pressured stocks to give up their early day gains. Yeah, the market the first few hours was in the green. And then I'd say probably after about 2 to 3 hours of being open, it went into the red for the rest of the day. The Federal Reserve kicked off its two-day meeting on Tuesday, but ahead of the central bank's rate decision on Wednesday, there has been a late flurry of bets on Fed delivering a 0.75 or a 0.75% rate hike rather than the 0.5% expected. About 94% of traders expect the Fed to deliver the 0.75% hike on Wednesday, a sharp increase from the 6.9% seen in the week prior. According to investing.com's Fed Rate Monitor tool, technology stocks attempted to pare some of its losses from earlier in the day, but dip buying action was limited by rising Treasury yields ahead of the Fed's decision. The United States 10-year yield briefly topped 3.45%, a fresh 11-year high. Big tech, excluding Meta Platforms and Amazon, traded mostly higher, with Microsoft, Apple, and Alphabet up less than 1%. Oracle helped boost sentiment on tech stocks after reporting quarterly results that topped estimates, while guidance touted stronger demand for enterprise software spending. The full-year guidance, quote, suggests continued strength this coming year, with total cloud revenue expected to grow greater than 30% organically, and cloud license and support expected to see growth accelerating and could see double-digit organic growth, Credit Suisse said in a note. Twitter Inc. also bucked the trend lower as reports that Elon Musk will attend an employees all-hands meeting later this week boosted hopes that the billionaire will follow through on his $44 billion deal to take the social media giant private. What I've been hearing, just some things I've read here and there, is that what he's planning on offering is a price per active or real user, as opposed to the bots and all the other crap that's in the system. So I wonder if he's going to take that 44 billion and divide it by the users that they claimed at the original point in when they first made the offer. Divide it. This is the price per user based upon that number, and then once you back out all the fake accounts, multiply that price per user. And then you get, let's say it goes from 44 billion down to, let's say a third of the users are fake. We're down around, 30 billion at that point. So, but we'll see. I'm not really worried. I don't use Twitter hardly at all. I got a social media page, which I don't think many people actually look at. And, I have a personal one just for, if I need to go on there and read something, but it's not something I go on a regular basis. There's a lot of idiots on there. It's mostly leftists who have zero grasp of reality. All right, next, energy, which was the biggest decliner a day earlier, rose more than 1%. Defensive sectors of the market, including consumer staples and utilities, which often serve as bond proxies, were the biggest decliners on the day under pressure from rising Treasury yields. Clorox, Procter & Gamble, American Water Works, and Pinnacle West Capital Corp were among the biggest decliners, down more than 3% and 5% respectively. Crypto-related stocks showed little sign of staging a comeback after Coinbase saying it would slash 18% of its workforce, flagged worries of a recession in crypto winter amid a rout in cryptocurrencies, including Bitcoin. In other news, FedEx Corporation jumped more than 14% after raising its dividend more than 50%. Wow, that's pretty nice. Dividends are always good if you own the stock. So, yeah, as far as the crypto market, I know it's going through a lot of gyrations right now, and probably, and again, this is not financial advice about crypto, but just common sense. If you're someone who believes in it long term, hold on to it. If you feel that this is a buying opportunity, get some more. If you're sick of it, dump it. There's no right or wrong answers, and odds are you'll wind up kicking yourself, a decade from now, regardless of what you did. Kind of like with Bitcoin, a decade ago, my younger boy was investing in it when he was a teenager in high school, and I wish he had said, been more of a, hey, Dad, why don't you buy 50 of these coins? They're going for nothing. And but hey, I was focused on the financial markets and stocks and bonds and things like that. And I really like the idea of crypto. I definitely see a place in it. Here in the future, I wish our government had more of a sound system that was based upon a set number of tokens or units. It would avoid the inflation that we're dealing with right now, but is what it is. I mean, I'm not really in favor of the Fed being in charge of a digital currency, but because they don't exactly have a track record of making good decisions. But anyways. All right, moving on to the next article. U.S. rate markets price in aggressive 75 basis point hike on Wednesday. Investors have dramatically raised their bets on the U.S. Federal Reserve will raise interest rates by 75 basis points rather than 50 on Wednesday, a swing in expectations which has fueled a violent sell-off across world markets. Expectations for a 75 basis point hike at the June meeting jumped 89% on Tuesday from only 3.9% a week ago, according to CME's FedWatch tool. Consequently, expectations of a 50 basis point hike on Wednesday have melted to 11% from a surefire bet a week earlier. Investors worry that a 75 basis point rate increase would be the biggest since 1994, will negatively impact the valuations of equities, particularly technology stocks, and jeopardize the post-COVID-19 recovery. Well, let me stop there. I would argue that, and let me bring up my chart here. So this is the Dow Jones. This drop right here was, let me make that larger so you can see it. This drop right here was the COVID collapse. And then somewhere in this point, here in the summertime of 2020 is when, the Fed and the Treasury and our government decided, hey, it'd be really smart to increase the money supply by 40%. So, by the time it was all said and done, the market topped out at around 36,000. But, if you were to back out all the inflation in there, I mean, let's just do some quick math. I did this in a meeting earlier today. So 36,000 times, 60%, we're looking at like 22,000 in the Dow, which is where we were at this point, 2 years ago when they started all this money creation. So all they did was just prop up the economy, in my opinion. So anyways, let's go back to our article. Where was it? There it is. All right. Monday's sell-off confirmed a so-called bear market for the U.S. S&P 500 equity index, which is down more than 20% from its most recent closing high. On Tuesday, investors continued to sell U.S. stocks as investors braced for an aggressive Fed. In the Treasury markets on Tuesday, U.S. two-year Treasury yields, which are highly sensitive to rate expectations, spiked to 3.439%, the highest since November of 2007. The benchmark 10-year yields touched 3.479, its strongest level since April of 2011. The yield curve between the 2 and the 10-year notes briefly inverted as on Tuesday as far as 5.4 basis points, which typically suggests an incoming recession. Weird. Totally caught off guard by this. The curve was last steeper at 4.2 basis points. And let me bring up a dynamic yield curve, and you can see here where on the shorter end, it's actually higher than the 10-year. So not good. Right here it says it's a flat market. We can go back through history and look and see. We had it back in 2019. See how the curve was flat or inverted in a few spots. And you go back, look through the history, see it's a normal curve. And mysteriously back right before the market collapsed with the housing crunch, it inverted again. It's like it tells you ahead of time. Anyways. All right. In the Treasury markets on, oh yeah, we already read that. The Fed ends its 2-day meeting on Wednesday amid data last Friday showing that U.S. consumer prices rose at their fastest pace since 1981. Data showed that in the 12 months through May, the U.S. Consumer Price Index surged 8.6%, the largest year-on-year increase in roughly 40 years. The so-called core CPI climbed 6% in May on a year-on-year basis. Some investment banks, including Goldman Sachs, said they now expect 75 basis point increases in June and July, and then a 50 basis point hike in September. TD Securities expects the same quantum of rates in June and July. Quote, the market has quickly adjusted rate hike expectations for the next few meetings, including 75 basis points in each June and July, said Marcio Aguadello, head of fixed income investments at Homestead Funds. Quote, in our view, the market is already doing the tightening for the Fed. Therefore, the Fed must deliver. Yeah, because I think if the Fed, weasels out and only does 50 basis points or, not that they would do less than that, in my estimation, but if they were to, go dovish or, limp wrist this, that's going to be a huge sign to the investment world that they're not in control the situation and would really have a loss of confidence long term. So, all right. U.S. fuel and trucking costs, power producer inflation. The producer price index numbers came out today. So let's go ahead and read through this. U.S. producer prices increased solidly in May as the cost of gasoline surged, another sign of stubbornly high inflation that could force the Federal Reserve to raise interest rates as much as 75 basis points. The Labor Department on Tuesday, the Labor Department report on Tuesday follows news last week that consumer prices accelerated in May, culminating in the largest year-on-year increase since 1981. Globally, inflation has surged since Russia invaded. Oh, come on. Inflation was already well above norms last fall, and to blame this on not that the Russia-Ukraine thing helps, but it's certainly not the catalyst for the problems we're seeing right now. It's what the Fed did 2 years ago, and it's Obama and Trump keeping interest rates at zero for more than a decade. I mean, there's no good guys in government. I hate to be the bearer of bad news, but these people are schmucks. All right. Quote, producer prices increases continue to shoot higher, which means even more pipeline pressures for consumer in the months to come, said Christopher Rupke, chief economist at Forward Bonds in New York. Quote, this argues for a strong response from the Fed officials to somehow get out in front of market expectations and tell the public they are winning the inflation fight, end quote. Again, they should have been doing stuff a year ago instead of, dismissing it as transitory and temporary, and it's not a big issue. The producer price index for final demand rose 0.8% last month after advancing 0.4% in April. A 1.4% jump in prices of goods accounted for nearly 2/3 of a rise in the PPI. Goods prices, which rose 1.3% in April, were driven by soaring costs for energy products. Wholesale gasoline prices rebounded 8.4% after falling 3% in April, making up 40% of the rise in cost of goods. Jet fuel increased 12% after shooting up 14.8% in April. There were also increases in the cost of residential natural gas, steel mill products, and diesel fuel. Wholesale foods prices were unchanged after increasing 1.4% in the prior month as the cost of beef and veal fell 9.5%. Steak. Excuse me. Offsetting an increase in processed young chickens. Excluding food and energy, goods prices rose 0.7% after increasing 1.7% for the 2 straight months. In the 12 months through May, the PPI increased 10.8% after accelerating 10.9% in April. Last month's increase in the PPI was broadly in line with economists' expectations. Stocks on Wall Street were lower. The dollar rose against a basket of currencies, and U.S. Treasury prices fell, with the interest rate sensitive 2-year note yield rising to the highest level since 2007. There's more to this if you want to read through the rest of it. That was the meat and potatoes of the PPI stuff. So, all righty. One last article here. I'm sure y'all are since we're technically in a bear market now on the S&P 500 and in the NASDAQ, which is down over 30% at this point from its previous peak. The Dow was still, I think, around 17-18% off its highs. So it's about this close to being in bear market territory. So I figure within the next couple of weeks, as long as the trend continues, we'll be there sooner than later. So this article, how long does the average bear market last? Let's see here. The S&P 500 entered bear market country on June 13th, down 21% from its high on January 3rd, while NASDAQ has been in bear market since March. Bear markets have a long history with the S&P 500, NASDAQ Composite, and Dow Jones Industrial Average Indexes, and they have returned as a result of economic turmoil caused by inflation, rising interest rates, high gasoline prices, and fallout from the Russian invasion of Ukraine. Yeah, you got to throw that one in there. That's got to be it must be standard in the Grammarly. It just puts it in there for these people. Some bear markets have occurred during recessions, while a decline in the gross domestic product and high employment, but that is not the case with current bear markets, at least so far. The S&P 500 joined the NASDAQ Composite in a bear market on June 13th after recording a 21% decline since reaching its high of 47.96 on January 3rd. S&P's previous bear market was its shortest one, lasting about a month in February 19th to March 23rd, 2020, when the index fell 34%. And again, like I talked about earlier, you poured all the cash into the system and it has repriced everything. And so is the market really as high as it should be? I would argue not. To me, it's overpriced, like that in the cleanest terms. The S&P 500, we already read that. NASDAQ already entered the bear market 3 months ago on March 7th when it had declined 20.1% from its high of 16,057 on November 19th, 2021. The tech-laden index on June 13th had fallen 32% below its high of 16,057. We already talked about that. The Dow Jones Industrial Average is down about 17% from its all-time high of 36,799 on January 4th. All right, bear markets can be short-term or long-term. A bear market is defined when an index declines 20% from its most recent high. The shortest bear market on record since 1928 is the S&P 500's February 19th to March 23rd, 2020 period of 33 days, which was brought on by the COVID pandemic, according to Seeking Alpha. Before the bear market of about 1 month, the S&P 500 recorded a 62-day bear market during the financial crisis from January 6, 2009 to March 9th, 2009, when the index declined over 27%. The S&P 500 had a much longer bear market during the financial crisis from October 9th, 2007 to November 20th, 2008, or 408 days when the index fell almost 52%. The longest S&P bear market stretched from January 11th of 73 to October 3rd, 1974. Hey, that's a good year. Amounting to 630 days or 21 months when the index fell over 48%. Not surprising, the S&P had 10 bear markets in the Great Depression of the 1930s. The average length of a S&P 500 bear market based on Seeking Alpha's numbers is 268.3 days or about 21 months. NASDAQ has had some notable bear markets since the index launched in 1971, according to Motley Fool. Its worst bear market occurred during the dot-com bubble burst from early 2000 when the index fell 75% by mid-October of 2002. The bear market continued through the financial crisis of 2008 and didn't end until November of 2013. The index had another devastating bear market in 1973 when the NASDAQ fell almost 60% and didn't climb out of bear market for about 4 years. The index had other bear markets, including October of 87 as a result of the stock market crash. I think that was Black Monday. In July 1990 and in early 1982, which both coincided with recessions. Dow Jones Industrial Average on March 11, 2020 entered a bear market for the first time in 11 years. The index fell 38% from its high of 29,568 on February 12, 2020 to March 23rd, 2020 before it recovered, Investopedia reported. All right, so that gives us, I would probably gauge things, if you're looking at, your blue chip stocks, that'd be your S&P 500, that's your large cap, your big US companies. The average there was about 21 months, I believe is what it said there. Yeah, 21 months. So, somewhere between a year and 2 years. So if, we're just starting it now, so somewhere between a year from now and 2 years from now, we should be back on the other side where things have, reached back above, the levels of a few months ago. So we'll see where things go, but, it's not looking pretty. It's like I've been telling people, for those who've seen The Shawshank Redemption, those who remember Andy Dufresne had to crawl through that river of poop. We're getting ready to, put on your foul weather gear because we're going right through that stuff. And, it's easier to get through it faster. That's why I believe increasing interest rates as quickly as possible to squash the inflation that we're seeing. And, pretty much I'd have the government just get out of the way. I mean, frankly, I'd like to see the U.S. government completely disbanded and just let us, go back to the States, make life a lot easier without all this extra cost. Sending a third of what I make to the government every year is not exactly what I consider a good time. But hey, that's, I'm on my soapbox now, so I'll stop. Alrighty, folks. Well, that's everything I had for today. If anybody needs anything from me, please go to dsafinancialgroup.com. My email address is right here on the screen if you want to send me an email, and or if you want to book a meeting, the instructions are on there to book a meeting and get on my calendar. So hope everyone's having a fantastic Tuesday, and I will see you guys tomorrow. Bye.